Welcome to the study of accounting at Grand Valley State University. I'm really looking forward to our time together as we explore both financial and managerial accounting. Now, I understand that some people come with varying backgrounds. Some of you who are enrolled in the course may have accounting undergraduate degrees, and other people may not really know what a balance sheet is or how to distinguish an asset from a liability. So what we're trying to accomplish with this video is to set a baseline for some of the fundamentals of both financial and managerial accounting that will help you be successful as we study accounting over the next several weeks over this semester. At its core, accounting is simply measuring information that we've identified and then communicating it to people who need to make decisions. A lot of times I like to make a sports analogy. Pick your favorite sport. Baseball, basketball, football. There's all sorts of information being identified, measured, and communicated. Whether it's simply the score of the game to see which team won, or maybe some detailed statistics about somebody's batting average, or a pitcher's earned run average, or something like that. We see that kind of measurement, identification, and communication in sports, and we're seeing the same thing happen in business. But with business, it's dollars and cents that are being reported, or maybe other metrics that are relevant to the business. So accounting is simply identifying information, measuring it, communicating it to people who need to make decisions. Now, there are two broad categories of accounting, if you will: financial accounting and managerial accounting. Financial accounting focuses on conveying information to people who are outside of the organization, external users who need to make decisions. Maybe users such as a bank that might make a loan to a company, or an investor who's trying to decide whether or not to buy shares in a company. Managerial accounting focuses on internal users and internal decisions. Those are the two broadest categories of accounting. Now, certainly there are other uses of accounting information. For example, the IRS needs information for determining your tax liability and assessing whether or not that's accurate. And we've even seen lately sometimes triple bottom line reporting. So in other words, not just financial reporting, but also companies measuring and assessing their social and environmental impacts. So non-financial measures as well. At the core, though, we're giving people information for decisions. Now, as we think about financial accounting, I like to think about a very fundamental concept. Financial statements are supposed to help people assess future cash flows. Now, of course, they're not a crystal ball, so we can never predict with certainty, right? We can't say for sure how much cash is going to flow in the future, but the financial statements are supposed to give us information to help users assess future cash flows. In particular, how much, when, and how likely are the future cash flows. As you take a look at a balance sheet and an income statement, you will be able to hopefully identify information that will help you assess when cash is going to come into the organization, when cash is going to leave the organization, how much those amounts are, and how likely or unlikely are those cash flows. Now, we talked about users, and I mentioned a couple of external users, investors and creditors. But those aren't the only examples of people or entities that might be using financial accounting information. Sometimes a company's suppliers want to see financial statements to determine whether or not the company can pay for the supplies or the merchandise or whatever it's buying from the suppliers. Sometimes customers want to see an entity's financial statements. Take this as an example. Let's say that you are a road construction contractor and you're going to seek a contract with the state of Michigan to repair a stretch of highway. The state of Michigan probably wants to see your financial statements to understand your health, the health of the entity, to determine that you are going to be healthy enough with likelihood to be able to complete that construction project. So these are some examples of the external users who might be using financial accounting information. Managerial accounting, as a reminder, is more inwardly focused. It's used to develop information for managers to make decisions internal to the organization. Managerial accounting helps give information about planning, controlling, and then making decisions within the organization. We're going to spend a lot of time looking at various aspects of managerial accounting, from budgeting to cost, volume, profit analysis, where we will look at the impact of certain choices. So when we get to managerial accounting, just understand that it's planning, controlling, and decision making for internal users. As we look at some of the fundamental differences between financial and managerial accounting, I can think of 7 main differences. First and foremost, the users. As you know, with financial accounting, external users, whereas managerial accounting is primarily internal users. Now, that doesn't mean that these are mutually exclusive. Certainly, managers might use some financial accounting information, and there are times in financial accounting where we lean on managerial accounting information, but the primary foci are external for financial, internal for managerial. Financial accounting is really financial history. Financial statements for external users focus on recording what happened in the past. Now, of course, I just told you that financial statements should help users assess future cash flows, and that's true. They make those assessments using information about what happened in the past. So financial accounting looks at the past, whereas managerial accounting, remember, we're looking at planning, controlling, decision making. Those are things that affect the future of the organization. And these are not mutually exclusive. Certainly, sometimes financial accounting can help us, as I said, assess the future. And managerial accounting often uses past information to make decisions about the future, but their primary foci, financial accounting in the past, managerial accounting in the future. Now, these next 2 differences really kind of tie together. Financial accounting focuses on being verifiable, being objective, okay? So in other words, if we want to determine whether or not this asset on the balance sheet is valued at an accurate historical cost, we can simply look up the invoice or the payment and we can verify that that happened. And certainly you could do something like that with managerial accounting, but remember, managerial accounting, being forward-looking, is really worried more about getting relevant information to users so they can make those decisions, and so they can make those decisions in a timely manner. Financial accounting is more concerned with precision than with the timeliness of the information. Now, don't misconstrue my message here. It doesn't mean that we can wait a year or two to produce the year-end financial statements. That's not the case at all. We certainly want to get financial information out in a timely manner, but we also need to balance that with precision. Whereas with managerial accounting, it's not like we are going to have shoddy workmanship or something like that. We're not going to be loosey-goosey with our measurements, but we may sacrifice a little bit of precision in order to get timely information so we can make quick decisions and be nimble as an organization. Because managerial accounting is so focused on forward-thinking decisions that impact the future, sometimes time is of the essence. And so we sacrifice a little bit of precision so that we can get information in people's hands and they can make a decision right away. Financial accounting tends to look at the organization as a whole, whereas managerial accounting, we may disaggregate. And what I mean by that is, with managerial accounting, we may break the financial performance of the company and look at it by product line or by geographical area or by certain lines of business, perhaps. Or even get down to the level of an individual product or an employee or something like that, a division of the organization. Financial statements for external users tend to look very broadly at the organization as a whole, whereas managerial accounting, we need to get more granular so we can make good future decisions. Then we have rules. Financial accounting typically follows a financial accounting framework, financial reporting framework, such as generally accepted accounting principles in the United States, called U.S. GAAP. There's also IFRS, International Financial Reporting Standards, for companies that operate outside of the U.S. And there are actually other frameworks as well. Some companies can report on the modified cash basis or on the income tax basis, but there's usually a framework that we're following for this external reporting. Whereas for managerial accounting, there might be best practices, there might be guidelines, but there's no prescriptive rules. There's not a standard setting body for managerial accounting. And then finally, the requirement. Financial accounting is often mandatory. The reason I say often mandatory is because there may be circumstances where a company does not have to report externally, but most companies have some circumstance that cause them to have to report externally. For example, if you're a publicly traded company, you need to produce external financial statements. If you're not publicly traded, so in other words, if you're a closely held family business, you may not have a requirement by the SEC to produce financial statements, but you may obtain a bank loan and the bank requires you to produce financial statements. So for financial accounting, there's often some kind of an external requirement that's forcing us to do this. Whereas managerial accounting, it's not required, okay? It's a good idea. You can make better decisions if you have quality managerial accounting information, but at the end of the day, it's optional. I'd like us to explore the 4 basic financial statements that are used for external reporting with financial accounting. But before we do that, let's consider this concept. Every activity of a business entity, or really any organization, can be divided into these 3 categories right here: operating, investing, and financing. Let's take a look at financing first. Okay? Pretend you have a brand new business. Let's say we're going to start a brand new restaurant. So we form the business entity, whether that's a corporation or an LLC or something like that, and that business entity owns nothing. It's like a baby coming into this world, penniless. So where is the business going to get its money? Well, could borrow money from a bank or another lender. That would be a financing activity. We could also obtain cash from investors who will then have shares of stock or percentages of membership interest for a limited liability company, but then they would have an ownership in our business. So financing activities explain how our company obtained cash, but not from customers, from external sources like lenders or investors. Now, continuing with the financing activities, as we repay the principal of debt, so money that we borrowed, that's going to be a financing activity, but that's cash leaving the business. And as we pay perhaps dividends to our shareholders, that's also a financing activity related to that relationship with the shareholders. So financing activities, you can think about it this way: borrowing money, repaying the loans, issuing shares of stock or other equity to owners, and then making repayments to them in the form of dividends or other distributions from the company. Now, continuing with this restaurant example, we obtain some cash. Let's say that we borrow some money from the bank and we issue some shares of stock, and both of those financing activities give us money. What are we going to do with the money? Well, eventually we want to run the restaurant, but we're going to need some equipment, right? And maybe a building or something like that. So the investing activities, these involve the purchase and sale of long-term assets. So we take some of this money that we obtained from the financing activities, and then we purchase an oven, some furniture. Maybe we buy the building. Okay, we could rent it, of course, but maybe we buy the building. These would all be long-term assets that we will use in the business for years to come. Those are investing activities. Investing activities could also involve the sale of long-term assets. Let's say that a few years down the road, we decide to sell the old oven and purchase a new oven for the restaurant. Well, the sale of the old oven is an investing activity that's actually going to bring cash to the organization because we're selling the asset. And then purchasing a new oven would be an investing activity where we use cash to purchase that long-term asset. Investing activities could also involve maybe buying stocks or bonds. What you typically think of as investing. Maybe you individually buy stocks, bonds, mutual funds. Businesses can do that, and that would fall in the investing category. Also, it's possible that we might loan money in the capacity as a lender to maybe another business or to just another entity. We could also put that in the investing category. That brings us to operating activities. Operating activities are the reason you're in business. With the restaurant example, that would be making food, selling it to customers. So making a sale to customers is an operating activity. Paying our employees, paying our suppliers, paying for insurance, paying for electricity to light the store, paying for natural gas to heat the ovens and maybe climate control in the restaurant. Those are all operating activities. So think of operating activities as being the day-to-day activities of the business. Keep these in mind as we look at the 4 basic financial statements. Now, before we look at the financial statements, we do need to talk a little bit about vocabulary. And in my experience, I've been teaching financial accounting for 13 or 14 years at this point. Sometimes people struggle most with the vocabulary. So take a little bit of time in your studies to make sure that you understand some of the key terminology. Every account of a business can be divided into one of these 5 categories: assets, liabilities, owner's equity, revenues, and expenses. I want to point one thing out about owner's equity. A lot of times, and probably in your textbook, it's going to say shareholders' equity or stockholders' equity. And what that is, that's very specific to a corporation. But a corporation is not the only form of business that we can use for making our entity. It could be a limited liability company, in which case this would be called members' equity. It could be a partnership, where this would be partners' capital account. It could be a sole proprietorship, where we would call this proprietor's capital. So a lot of times I simply, I use a more general term, owner's equity, because that covers stockholders in a corporation, members in an LLC, and any other form of entity that we might choose. So as you take a look at these terms here, assets, I like to think about it as what the business owns. Okay? If you think about assets, more is typically better. More cash, more accounts receivable, which is what customers owe to us. More inventory within reason. Okay? Assets are the good things. Liabilities, those are what we owe to others. Maybe it's a loan to a bank, so we owe money to the bank. Could be something called accounts payable, where we owe money to our vendors. It could be something called accrued payroll, where we're looking at, we didn't pay our employees yet, but they worked for us. It's just payday is next week, so we actually have a liability to our employees in this example. Owner's equity is really, it falls into 2 main camps, okay? So you have contributed capital. That's the money or other resources that the owners have contributed to the business entity. Could be common stock, could be preferred stock, could be a membership interest if it's an LLC. But the takeaway is this: it's capital contributed to the business by the owners of the business. Now let's contrast that with retained earnings. Retained earnings is really owner's equity that comes from the profitable sales with customers. So we run our business, we conduct our operating activities, and if we do it right, we generate a profit. That profit will be retained within the business as owner's equity. As the business is more profitable, the business becomes more valuable because owner's equity will get bigger. Now, of course, you might want to take a distribution from the business. If it's a corporation, it'll be called a dividend. If it's another form of entity, it'll have different terminology, but the concept is the same, is that maybe some of those earnings are not going to be retained within the business, but we're going to distribute some of those to the owners of the business. That would be a reduction of owner's equity. Now, if we look at here, revenues and expenses, this is really your income statement here. Revenues are inflows from our customers. So we make a sale to our customers. Whether we sell them a product or we provide a service, we're going to measure the financial value of that product or that service, that item, that thing that we're selling to our customers, and we're going to call that revenues. Good things. Expenses, you guys have probably heard you have to spend money to make money. So expenses are outflows that we need to incur in order to generate revenues. What you're seeing here is we do have two major financial statements already listed here. What you have on the top here, this is essentially your balance sheet. And we're going to look at that in a little bit more detail in a few minutes. This right here is essentially your income statement. So we've got the balance sheet, which tells us what the business owns and what it owes. And the income statement really covers the results of the business's operations. The external reporting that happens with financial accounting involves four basic financial statements: balance sheet, income statement, statement of cash flows, and then some sort of statement of owner's equity. Again, I've generalized this because if it's a corporation, it would either be called a statement of retained earnings or a statement of changes in stockholders' equity or something like that. But I'm kind of generalizing it here. Let's take a look at each one of these financial statements. The balance sheet, as you might recall, explains what the business owns and what it owes. What you own and what you owe. We've got a coffee house here, and we have balance sheets for 2 separate years. Now, the first thing I want to point out is that the balance sheet really measures a point in time. This is not a period. This is not multiple days. This is a very specific point in time. In particular, December 31, 2018, and 2017. So what this is really measuring is what did this business own and what did it owe when the ball dropped on New Year's Eve at the end of 2018 and the end of 2017. Okay? That's a very important concept to understand, that the balance sheet covers this specific point in time. And as we look at it, I had promised you that assets, liabilities, and then the owner's equity would all kind of roll together on the balance sheet, and that's what we're seeing right here. Remember, assets are what the business owns. These are things that have a future economic benefit to the business. They're helpful to the business. Take the most basic asset, cash. At the end of 2017, we had $15,000 in the bank or in multiple bank accounts. And at the end of 2018, we had $22,000 in the bank. So we would look at this one particular asset. Cash is the most liquid asset, and we would say, oh, the business got a little bit more liquid from year to year, at least with respect to that one account. Then we look at accounts receivable. This measures amounts that our customers owe to us. In other words, we made a sale to them, but they didn't pay us yet. So it's not cash. Hopefully it will soon become cash. If it doesn't become cash soon, we need better customers. But it's still an asset. This is an economic resource of the business. Then we move down and we see inventory over here. Inventory, now this is a coffee house, so that's going to be stores of food, ingredients, things like that, maybe even napkins, plates, things that we will consume as we operate the business. In particular, things that we will consume and sell to our customers, okay? So it could be inventory of that nature. We could also see an asset here called supplies. Those are things that we would consume but then maybe use within the business. Then we've got this weird animal here, prepaid rent. What a weird concept. How is that a value to the business? Well, what we're seeing here, at the end of 2017, we had prepaid rent of $5,000. At the end of 2018, it was $6,000. Let's assume that the business's rent is $1,000 per month. That means that they had over here 5 months of rent prepaid, over here a half year of rent prepaid. In essence, they paid for some of their rent in advance. And we did not want all of that to be an expense on the income statement, which we're going to look at next. Instead, we keep it on the balance sheet because it does have future value. What this is telling you is this business would be able to occupy its space, whatever area it's renting, for the next 6 months without writing another rent check. Now, you can see here, this is a classified balance sheet, and we called these current assets. What that means is we expect those assets to either be cash or become cash or be used up, consumed within the next year or the operating cycle of the business if that happens to be longer. For most businesses, we're going to assume 1 year. There are certain industries where the operating cycle is longer than a year. Think about shipbuilding or building Boeing 737 airliners. Things like that might take longer than a year. But for most businesses, 12 months really covers it. So think about this as being within the next 12 months, these assets here are expected to become cash or be used up within those 12 months. Remember the future cash flows, right? The amount of future cash flows, the timing, and then the likelihood. If we think back to those fundamentals. Well, we have the amounts here. As far as likelihood, we'll talk about that in a different lecture. But think about the timing here. What this is telling us is that within the next 12 months, we expect these assets to become cash or to be used up, to be gone. These assets down here, longer than 12 months, okay? We would say this is going to be sometime beyond, the 1 year period. Equipment. These are the ovens and the stoves and the furniture and things like that. These are the investing activities that are showing up on the balance sheet. These are assets. They're benefit to the company. The company can use these assets to run its business, but we don't expect them to be converted to cash within the next year or used up within the next year. We expect to have these for a while. In fact, if you were to convert these to cash, that might not be a great thing for the business because eventually you wouldn't have anything available to be able to run the business. Now, then we have total assets. Now, the reason this is called a balance sheet is because if we add up all the assets here, that is going to be equal to the liabilities and the owner's equity combined. See if I can do a better circle on that for you guys. Okay, and that's a fundamental thing. We're going to talk about this in a little bit more detail later, but the fundamental accounting equation, assets equal liabilities plus owner's equity. Because down here with the liabilities, what's happening here, these are things that we owe. Accounts payable means that we purchased some things from a supplier or suppliers, and we owe them money. We did not pay for it yet. Accounts payable is really the counterpart to accounts receivable. With accounts receivable, customers owe us. With accounts payable, we owe our vendors or suppliers. And on their books, our account payable would be an account receivable on their books. Then we have some other kind of short-term payables here. Maybe we owe our employees a little money. We owe some interest on the bank loan. Sales tax. We collect sales tax from our customers, and we actually have to remit that to the state government. And that's a short-term liability where we're just kind of holding the state's money for a little bit. So go back to that timing. All these current liabilities, we expect to have to pay these within 12 months. So do you see how the balance sheet is starting to paint a picture of future cash flows? These are the amounts here that we expect to convert to cash or use up within the next year. These are the amounts that we expect to have to pay within the next year. And you can start to make some assessments about the health of the business in the short term. Current assets are $91,000. Current liabilities are $51,000. That is one metric that paints a favorable picture of liquidity or short-term health of the business. because really our current assets are almost double what our current liabilities are. That's a good thing. Now, certainly some liabilities could be non-current, and these are going to be beyond 12 months. For example, a bank loan that we have here. It's a note payable. We're going to be making some payments on that over the course of time. I don't know if that's 5 years or 10 years or whatever, but just think about your own mortgage and see how this information in the classified balance sheet helps us assess the future cash flows, because we know that we have to come up with this money for these current liabilities within the next 12 months. But these liabilities, we know that we have a little bit longer. Now, there will be disclosure notes at the end of the financial statements that will give us even more context regarding that long-term note payable, like the term and the monthly payments and things like that. But at the core, as we just kind of look at the face of the balance sheet, we can see that this is going to be owed at some point in the future. And then finally, we have owner's equity. In this case, it is a corporation, so we're going to call it stockholders' equity. This common stock is contributed capital. In other words, the stockholders of the company contributed $30,000 in exchange for shares of the company. The retained earnings, and if we just kind of look at the end of 2000, my circle's not the best, but you guys can probably make it out there. At the end of 2018 was $256,000. What that tells us is that the business has operated and generated a profit in past years. And that's the amount of the accumulated profit that has been generated by the business since its inception that has not been taken out by the owners in the form of a dividend, in this case with a corporation. So the balance sheet really tells you what you own and what you owe at a point in time. So the balance sheet covers a point in time, but the income statement covers a period of time. The income statement is really measuring the results of our company's operations. And it's important to designate what is the period of time being covered. In this case, what we're seeing is it's measuring the entire year of 2018 here, the entire year of 2017 here. And it's important to be specific. It would not be good enough to say for the periods ended December 31, such and such year, because that could just be the month of December. It could be the last quarter of each year. It's not specific enough. But we know here we're seeing the results of an entire year's operations for 2018 and entire year's operations for 2017. And the income statement can have different versions. There's a single step, there's a multi-step income statement. What I'm showing you here is a multi-step income statement. They both get to the same bottom line net income. You can think of net income as being profit. Okay? But the multi-step income statement has a few subtotals along the way to give the users a little bit more granular information. Let's take a look kind of line by line here. So we've got total revenue. This first category, these are inflows from our customers. So we're running a coffee house and we choose to disaggregate that revenue into beverage sales and food sales. There's really no requirement that we do that. What we want to do is we want to disaggregate it to a level that's meaningful to the people who are reading the financial statements. And apparently we've chosen these two categories. And it's not that we couldn't have others. Maybe we have a catering revenue category or merchandise revenue. Sometimes a coffee house will have t-shirts or coffee mugs or things like that. But we've kept it simple here. So these are the sales revenues earned from transactions with the customers. Now, you have to spend money to make money. And for a restaurant, cost of goods sold is going to be a pretty fundamental total for us there. So in other words, what did we pay for ingredients to make the coffee and to make various food products or whatever? I think about cost of goods sold as being very closely related to the revenues. In other words, you're not going to be able to generate revenues if you don't have this cost of goods sold. You're not going to be able to brew a cup of coffee if you don't have coffee beans. So that's the first major subtotal. And sometimes what can confuse people is we don't see any real minus signs here until we get down to the bottom. It's just generally understood that if you're reading an income statement, you're going to subtract an expense to arrive at whatever next subtotal. 627,000 minus 123,000 gives us a gross profit of 504,000. We don't put a minus sign there, it's just understood. And the same thing is true here, our operating expenses. These all reduce our profit or net income, but we don't depict them with a minus sign. It's just generally understood that expenses cause your profit to shrink. That's why businesses want to control their profits, obviously. Now, when we get down here to operating income, what we're really measuring here is this is the results of our day-to-day operations. This is the financial impact of the reason that we're in business. There might be other things that would impact our profit. Maybe miscellaneous income or interest expense or miscellaneous expense, or maybe the gain or loss because we sold an old oven or something like that. Those would kind of be down here, not really part of our day-to-day operations because it might be different next year. We may not even have this miscellaneous income in a future year. So we just kind of group them down here into other. And that's where we do get a little bit, these parentheses mean that this is a negative item. And the reason we're putting parentheses there is simply because everything in this category could go either way. It could be something that causes income to be larger, like miscellaneous income, or it could be something that makes our net profit smaller, like interest expense. So in this case, we do denote the expense with a parentheses or negative, just because it's causing our profit to get lower. But what you're seeing is this. At our restaurant, for 2018, we generated a profit of $243,000. The previous year was $245,000, and that's really giving us the results of our operations for that time period. So we've explored the balance sheet and the income statement. Now we move to owner's equity. Now, as I had mentioned before, I generalize it because a business could be any number of different entities. Could be a corporation, could be a limited liability company. In this case, we are dealing with a corporation, which means that we have two broad categories for owner's equity. Some kind of contributed capital like common stock, and then you also have retained earnings. So common stock means that what's signified by that account is the owners have contributed capital, most likely cash, but it could be other assets. So let's assume they contribute cash, and then what they get in exchange for that is an ownership interest in the business entity. So that's contributed capital, contributed by the owners. Retained earnings is the result of running a profitable business and then having the business entity retain those earnings within the corporation. Earnings is a synonym for profits. So if we generate a profit, we've generated earnings. So when it comes to reporting owner's equity, what we're really doing is we're explaining how the owner's equity changed from one year to the next year, from one balance sheet date to the next balance sheet date. Now, in this case, retained earnings was the only owner's equity account that changed from year to year. If I go back and look at this balance sheet, you can see that common stock was the same at 2017 as the end of 2018. Retained earnings, however, increased from 248 to 256. So when we get to the owner's equity statement, we're just going to explain what happened to retained earnings. There's really no value in saying that common stock stayed the same. If common stock had changed, then we would have a broader, expanded statement, probably called a statement of changes in owner's equity. And it would explain the changes in both common stock and retained earnings. But let's keep it simple. So retained earnings started the year 2017 at $206,000. That also means that was the balance at 12/31/2016. So if you had looked at the balance sheet at the end of 2016, this is what would have been reported for retained earnings. The balance at the end of 2016 is identical to the balance at the beginning of 2017. And then we run the business for a year and we generated a profit of $245,000. That would be reported on the income statement. Now, if we had not taken any dividends, what would happen is the beginning balance of retained earnings would simply increase by the amount of net income or earnings that were generated during that year. So it would go up to, what is that, $451,000. However, we paid distributions to the owners. In a corporation, it's called a dividend. So we deduct that from retained earnings. Because we paid this dividend to the owners, some of the earnings have not been retained in the business. Now, if this concept of retained earnings is confusing to you, I think that makes you normal at this stage of the game. It's an odd concept because retained earnings is not cash, it's not equipment, it's not any particular asset. It's really just this equity that's been generated because the business has been run in a profitable manner. Think about it this way. We run the business, we generate a profit, and a profitable business is going to be worth more than a company that does not generate a profit. So the fact that we're generating this profit here in 2017 and 2018, that makes the business more valuable. That's the concept of the retained earnings, owner's equity getting bigger because of these earnings we've generated. Then, to the extent that we distribute some of those earnings to the shareholders, we treat those as a reduction of retained earnings. We're going to look at that statement in a little bit more detail in a few minutes, but let's turn the page and look at the statement of cash flows next. We've seen the income statement, the balance sheet. We looked at the statement of retained earnings, which is owner's equity. The fourth major external financial statement is the statement of cash flows. And this will be clearer as we progress in our study of financial accounting. In particular, we're going to talk about this in a few minutes. There's this concept of accrual accounting. And what that basically means, at least at this stage of the game, is that we might measure things on the income statement before or after they actually appear in our company's cash accounts. Okay? Like I say, more details on that in a few minutes. But because of that, the income statement does not necessarily measure what has happened to our cash account, to our checkbook, if you will, because of this concept of accrual accounting. That's where the statement of cash flows comes in. Statement of cash flows is fundamentally important for explaining where did a company obtain its cash and where did it spend its cash? What were the uses of cash? Now, remember those three basic activities: operating, investing, and financing. The statement of cash flows is divided into those three categories. In this particular example, I did not include an investing section. And I did that simply to keep it simple and to make it fit onto one slide right here. Most businesses would have an investing section that would be right in here in between operating and financing. And the investing section would depict purchasing long-term assets, selling long-term assets. But let's just pretend that this is an established business. They did not have the need to buy any furniture or new equipment or anything like that. And they also did not sell any long-term assets. So we're just kind of skipping the investing section. As we progress in our studies later in the semester, you'll see plenty of examples where we have an investing section in the statement of cash flows. So here we have operating and financing activities. Now, there are two different ways of preparing the statement of cash flows. There's a direct method and there's the indirect method. And we'll explore those in more detail as the semester goes on. The method you're seeing here today is indirect method. And what that basically means is we start with our net income that came from the income statement, and then we make some adjustments to net income. Things that influenced net income but did not affect cash. For example, there's this odd concept called depreciation, where we take our long-term assets, and we I won't say get rid of, but we reduce the asset on the balance sheet systematically over time by converting it to an expense. Now, depreciation expense does make our net income lower on the income statement, but it does not affect cash. We don't need to spend cash to incur this expense. So we actually add this expense back to net income. Then we get to some of our changes in current assets and current liabilities. And I'm not going to go into the rules for whether you add or subtract at this point. That's a different lecture for when we're in class together. We'll explore that in more detail. But these, I'll give you an overview. But basically this is these are things that impacted the income statement but did not impact cash. So we have to adjust for those effects. At the end of the day, what we have here is this is the cash provided by operating our business, our operating activities. And you might start to see that it's fundamentally important to have a positive operating cash flow, at least in the long term. Sure, you could have a year or two where your operating cash flow was negative, especially maybe if you're in a growth mode or something like that, or early stage of the business. But that wouldn't work in the long term. In the long term, you need to have positive operating cash flow. Because remember, the operating activities, those are the day-to-day activities. That's the reason we're in business. And if you cannot generate cash for the primary reason you're in business, you're either in the wrong business or you need to learn how to run that business in a better manner, right? So we're looking for positive here. Now, the financing activities, that could be we're borrowing money from a bank or from another lender, and that would be a cash inflow. It could be that we are issuing common stock or other owners' equity. That's a cash inflow. But in this case, we don't have any inflows in this category because we're running a profitable business. So what we're doing here is we've got cash leaving the organization, repaying debt, the principal portion, and paying dividends to our owners. You might remember we had those dividend payments that were on the statement of retained earnings. They're right here as well. So what we're seeing with this business is we provided cash because of our operations, which is great, and we're using a big chunk of that cash to repay some long-term debt and to provide a return to our owners in the form of dividends. So we see that operating cash flow, for example, in this case, is $248,000 positive, and then the financing activities used $241,000. That means that our cash balance increased by $7,000 from the beginning of the year to the end of the year. And that explains how our cash balance at the beginning of the year went from $15,000 to an ending balance here of $22,000. We'll look at those relationships in a few minutes, but understand that a lot of financial statement users, they look to the statement of cash flows to get insights regarding this lifeblood of the organization. An organization cannot survive without cash. You need cash to pay your employees, to pay your suppliers, to pay your rent, all those types of things. So this is such a critical statement to bring everything together. And when used with the income statement and the balance sheet and owner's equity, all those statements in concert really help us get a picture of what's happened in the past with a company, and then help us also assess those future cash flows. How much, when, and how likely. These are the same financial statements that we've been exploring for the past few minutes. But I want to show you some of the relationships that exist. So I like to think about retained earnings as really being the keystone of the financial statements. And here's why. I've got an excerpt of the income statement. I shortened it, but you can see the revenues and then the bottom line net income, and an excerpt of the balance sheets as well. And again, I cut out some of the middle portion here, but you can see the total liabilities and stockholders' equity over here, the very end of the balance sheet. Now, what I'd like to point out is this. Look at the balance in retained earnings at the end of 2017 $248,000. That matches up right here with the balance and retained earnings on the balance sheet at the end of 2017. This is why I think retained earnings is really the keystone of the financial statements. Remember that the balance sheet has to balance. The assets need to equal the total of liabilities and stockholders' equity. I'll just put that up here as a reminder. Assets equal liabilities plus stockholders' equity. That's basically the balance sheet in the form of an equation. So how does this tie together? Well, look at the net income from the income statement from running our business for the year 2017. That net income is a component of retained earnings. Retained earnings began the year $206,000. Then we ran the business, generated a profit of $245,000. That caused our retained earnings to increase. Then we paid those dividends to the shareholders, which caused the retained earnings balance to decrease, ultimately ending at this balance right here, the $248,000. So the retained earnings ties the income statement with the balance sheet. And we'll see in a minute, it also ties in with the cash flows, because the statement of cash flows has some relationships we need to explore as well. This is the same shortened version of the income statement and shortened version of the balance sheets that we looked at just a moment ago. And what I wanted to do is explain how the statement of cash flows ties into these two statements. I should point this out too. The statement of cash flows covers a period of time, just like the income statement. In fact, the only financial statement of the four that is a point in time is the balance sheet, right? Remember, this is what we own and what we owe right at the end of 2018, right at the end of 2017. But all the other statements, the income statement covers a whole year in this case, statement of cash flows covers the same year. The owner's equity statement, the retained earnings, covered also the entire year. So the income statement, cash flows, and owner's equity, those are change statements that cover a period of time. Balance sheet is a point in time. And actually what we're going to do here is we're going to prove this cash balance, because at this point in time, our cash balance was $15,000 at the end of 2017. And you're seeing that right here at the end of the statement of cash flows. At the end of 2017, we had $15,000 in the bank. And guess what? That is going to be the same as the beginning cash for 2018. So ending 2017, we had $15,000. We better begin the next year with that same $15,000. Now the question is this: how did we get from $15,000 at the beginning of 2018 to $22,000 at the end of 2018? The balance sheet tells us where we got. We got from 15, we got over to 22,000, and that's great. But how did we get there? That's where the statement of cash flows comes into play. So the statement of cash flows, at least in the indirect method here, starts with what was our profit for the year. So our net income for 2018 was $243,000, and that's the starting point. And then we go through the various increases and decreases that we will go into in much more detail later in person when we meet. But at the end of the day, the change in cash during 2018 was cash went up by $7,000, and that explains how cash went from 15 to 22. So the statement of cash flows really ties together what's happening in the income statement and what's happening elsewhere in the financials to explain why the cash balance went from one point in time to a different point in time. To make these wonderful financial statements, we need bookkeeping entries. And there's a difference between bookkeeping and accounting. Bookkeeping is recording the transactions, and it's the fundamental record keeping. Accounting is really making decisions about how things should be measured, how they should be presented, depicted in the financial statements, what types of disclosures should accompany those financial statements. It's a much broader, more valuable practice. But at the end of the day, in order to accumulate the information so that we can report it to users, we need to go through a bookkeeping process. Now, this is not a course in bookkeeping, but you need to at least be aware of some of the fundamentals. And we get to this fundamental accounting equation. Assets equal liabilities plus owner's equity. In the realm of a corporation, as a reminder, it would be stockholders' equity, or it could be members' equity if it's an LLC or whatnot. But what we're seeing here is the balance sheet in the form of an equation. When we looked at the balance sheet, total assets equaled the total of liabilities and stockholders' equity a few minutes ago. Now, as we expand this accounting equation, what you can see is when our company generates a profit via net income through the income statement, that's where it's reported, owner's equity increases. And then when we make distributions to our owners, if it's a corporation, it'd be called a dividend. Different forms of business would have a different terminology, but the concept is the same. If we give owners a return on their investment, then that reduces owner's equity. Now, we can't completely escape debits and credits here. Let's talk about this for a second here. We have the 5 basic categories of accounts that can be used to keep track of a business's activities. And I don't care if you're as big as Facebook or Amazon or, Ford Motor Company, huge organization, or if you're as small as like the local coffee house or local plumbing shop, you would have these 5 basic building blocks. Now, of course, Ford Motor Company is going to have a whole lot more asset, liabilities, revenues, all individual accounts that they would use compared with maybe a small local business. But they're still going to have the 5 basic building blocks. Okay, what you own, what you owe, the owner's claims to the assets of the business, revenues coming in from customers, and expenses. We need those in order to generate the revenues. And we do this with something called double entry bookkeeping. What that basically means is that every transaction that needs to be recorded for the business is going to affect at least 2 accounts. And we're going to use debit and credit rules to determine whether an asset, liability, equity, revenue, expense, whether it goes up or down. Now, sometimes people, they think about debits and credits in terms of the cards in their wallet or their purse. Debit card, credit card. And you really need to break yourself of those preconceived notions, because debit does not necessarily mean increase or decrease. And credit doesn't mean increase or decrease. What it really just means is making an entry on the left side or the right side of an account. A lot of times we'll use something called a T account to depict this activity. So let me pick the most basic asset, cash. Okay. If you need the cash account to increase, then you're going to make a debit entry to that account. You're going to make an entry to the left side of that account. And if you need the cash account to decrease, you're going to make an entry to the right side of the account, which would be a credit entry. Now, let's pick a liability. Accounts payable. This measures what we owe to our vendors. We purchased something, we did not yet pay for it. This is going to be exactly the opposite. If you want accounts payable to go up, you make a credit entry. It's the opposite of cash. And if you want it to go down, you make a debit entry. So we're starting to see these debit and credit rules. The easiest way to remember it is to kind of just memorize what happens to cash. And you know that cash is an asset. If you can memorize what happens to cash, you can take these rules and you can apply them to any other one of these categories, and we'll see that in just a second. The easiest way that I know to remember the debit and credit rules is this. Memorize what happens to cash. Cash gets increased with a debit entry to the account. And once you know the rule for cash, you actually know the rule for all assets. The same will be true for inventory and accounts receivable and prepaid expenses, all these various assets. they all increase with a debit entry to the account. And if a debit entry makes an account go up, a credit entry will make the account go down. So if you know what happens to assets, then you can come down here and you can remember that expenses behave the exact same manner and everything else is the opposite. So liabilities, owner's equity, and revenues, they decrease when you make a debit entry and they increase when you make a credit entry. So memorize what happens to cash. That will let you remember what to do for any asset account. Then just understand that expenses behave the same, and liabilities, owner's equity, and revenue accounts, they are exactly the opposite of assets and expenses. That's the easiest way that I can think to have you remember the debit and credit rules. And so to just give you one example, let's say that we have our cash account right here, and let's say that we're going to pay for some insurance coverage, insurance expense right here. So let's think about what's happening. We're making a payment to our insurance company. So cash is going to decrease, and I'm just going to make up a dollar amount. Let's say it's a $1,000 payment for the current month. So cash decreases. We made a credit entry to the right side of cash right here. And what's going to happen is insurance expense is going to increase. Insurance is an expense, and we can see that making a debit entry to that account causes it to increase. Okay? What if it wasn't a payment for insurance expense? What if it was a payment for some inventory, which is an asset? Look what would happen here. In this case, we would have one asset decreasing with a credit. We would have another asset increasing with a debit. So keep these rules in mind. If you want an account to increase, you need to know whether a debit will accomplish the job or a credit is needed. If you want that account to decrease, you need to know, is the credit what's going to happen, or do we need to debit that particular account to make it go down? I hinted at this concept when we discussed the statement of cash flows. There are two broad options for measuring financial transactions on the external financial statements, either the cash basis or the accrual basis. And the best way that I've discovered to kind of explain this is actually referring to this United States Tax Court opinion. A good friend of mine who is a CPA in Iowa sent this to me when he was doing some tax research. You can even see he wrote classroom fodder over here. And he thought that would be an interesting way to illustrate cash versus accrual. And he's actually right. So keep in mind, this is a legal opinion from the United States Tax Court. It involved a newspaper company that I believe was trying to use the cash basis, and the IRS was asserting that they should use the accrual basis. And there must have been a secret, closet poet or a frustrated law clerk because the way this is written in this legal opinion, and I rarely just read a slide to you, but I'm going to read this, some portions of this here. Cash method, the accrual method, in section 446 of the Internal Revenue Code talks about here the change from cash to the accrual method. These are the two most common accounting methods and could be said to emblemise the polar nature of the human spirit. The cash method, simple, plodding, elemental, stands firmly in the physical realm. It responds only through the physical senses, recognizing only the tangible flow of currency. Money is income when this raw beast actually feels the coins in its primal paw. Expenditures are made only when the beast can see that it has given the coins away. The accrual method, however, moves in a more ethereal, mystical realm. The visionary prophet, it recognizes the impact of the future on the present, and with grave foreboding or ecstatic anticipation, announces the world to be. When it becomes sure enough of its prophecies, it actually conducts life as if the new age has already come to pass. Transactions producing income or deductions spring to life in the eyes of the seer, though nary a dollar has moved. Now, there's your poetry in this U.S. tax court opinion, but it really does explain the difference between cash and accrual. With cash basis, items are only going to be recognized or placed onto the income statement when they happen in the form of cash. So in other words, sales revenue from your customers only goes on the income statement when they actually pay you. And expenses to your vendors or suppliers or employees only go on the income statement when you actually make the payment. That's the cash method. When the beast either receives the coins or gives the coins away, that's when we place those transactions on the income statement. The accrual method is this visionary profit over here. And really the accrual method is placing things on the income statement at a time when they may not have actually affected the checkbook. So before or after we pay cash or receive cash. And I'll give you a few examples of that in just a second. U.S. GAAP financial statements, so generally accepted accounting principles, require us to use accrual basis accounting. And that's because accrual basis gives us better information about the amount, the timing, and the certainty of future cash flows. Let me give you these few examples right here. Take a prepaid expense versus an accrued expense. It's possible, let's assume that our rent is $1,000 per month. And we don't like to write checks, so we just write one check at the beginning of January for the entire year. So what we would do is our cash account would decrease in this example by $12,000. And we would have a new asset called prepaid rent that would increase by $12,000. Now, those of you who are thinking about the bookkeeping rules would know that this would be a credit entry, this would be a debit entry. But what you can see is happening here, both of these are assets. Okay? Nothing has touched the income statement. It's all on the balance sheet. Because what's happening is, January 1, I'll just pick 2019, we did not incur rent expense yet. What's going to happen is, these items, these values are going to stay on the balance sheet for a while. And then eventually what's going to happen, well, let's say at the end of the month, what's going to happen is this. We're going to get rid of a little bit of that prepaid rent. In fact, we're going to let prepaid rent go down by $1,000. And we're going to convert that into rent expense that will then be reported on the income statement. So you see what accrual accounting is letting us do. Here, we have something only affecting the balance sheet because it was not time for that expense to be on the income statement. And then what happened at the end of the month, when we have consumed some of this asset here, we take the asset down by $1,000 and we convert it to expense on the income statement because that measures what's happening in the operations of our company. At the end of January, the prepaid rent balance would be down to $11,000, which makes sense because we get to occupy the building for February, March, April, all the way through the end of December, 11 more months without writing another rent check. And $11,000 exactly measures the value of that prepaid rent. Now, what if the expense happens now and the payment happens later? So here's an example of an accrued expense. I'm going to take this situation right here, but let's say we have a super generous landlord. And I got to tell you, this probably wouldn't happen in the real world. But let's say that the landlord tells us we can pay their rent at the end of the year. So what has to happen is this. We still need this month of January to have $1,000 of rent expense because we occupied the building. So what we would do at the end of January, we would record $1,000 of rent expense, just like we did down here. So we put $1,000 of rent expense on the income statement. But remember, the visionary profit, okay? Nary a dollar has moved. So the grave foreboding here is that we recognize the expense, and now we would recognize also on the balance sheet a current liability called accrued rent. Okay? So you see what's happening here is it doesn't make a difference when the cash actually gets paid, whether we pay it at the beginning of January or whether we pay it some point in the future, maybe the end of the year. The timing of the cash flows differs, but the rent expense is still $1,000 on the income statement. And you start to see some of the value of accrual accounting now. Because if we're going to prepare an income statement for the month of January, we need to depict the costs of running our business that month. And it's important to depict the fact that we have $1,000 of rent expense in January, regardless of when we actually paid the rent. So this concept, I think, is probably one of the easiest ways to illustrate that accrual accounting. Let's take a look at one more example. We looked at an example involving expenses. Now let's take a look at an example involving revenue. You guys deal with deferred revenue every day. Okay, well, not every day, but I wouldn't be surprised if you deal with deferred revenue many times during a year. Every time you receive or purchase a gift card from a store, you're involved with an element of deferred revenue. So let's say that you want to buy a gift card for your favorite accounting professor, and let's make it Starbucks. Okay, so Starbucks gift card. So you go into Starbucks and you give them $20. They give you a gift card with $20. Here's what really happened with Starbucks. Okay, so we're accounting for this from Starbucks' perspective. Starbucks has $20. Okay, but they didn't do anything to earn that revenue yet. They're not going to earn the revenue until your favorite accounting professor goes in there and buys an iced latte or whatever. So when Starbucks initially issues this gift card, what they're going to do is they're going to credit an account called deferred revenue. This is a current liability account. Nothing has yet touched the income statement because Starbucks didn't earn that revenue yet. Everything here is on the balance sheet. Asset increases, current liability increases. Then down the road, when somebody uses that gift card, look what's going to happen. And let's just keep it simple. Let's assume that we use the entire gift card balance. So this liability account called deferred revenue is going to go away. And now on the income statement, sales revenue can be measured and recorded. So this is on the balance sheet, this is on the income statement. Look at what happened here. Accrual accounting allowed us to report the sales revenue in the period when it was earned. In fact, assume that this happened in, let's say, January, and nobody used the gift card until much later, maybe November. So the sales revenue should appear on Starbucks' November income statement because that's when they sold the coffee and pastries or whatever, not when they actually received the cash. So you see one of the fundamental differences. If we were using cash-basis accounting, this revenue would actually be recorded on the income statement in January because that's when the beast saw the coins in its paw. But under accrual accounting, the sales revenue gets deferred and reported on the income statement, not when we receive the cash, but when we actually fulfill the obligation to the customer by providing them with, in this case, food and beverage. Okay? And the balance sheet up here really protects the income statement. It keeps these dollars off of the income statement until the time is right. Now, of course, this is a situation where cash flowed into the organization before it was earned. It's possible, and it's actually quite common, to have a circumstance where you make a sale to your customer and then they pay you at a later date. Probably doesn't happen with Starbucks unless you're doing some kind of corporate event, but it happens all the time in business-to-business transactions. So let's say that we have a company that plows our parking lot in the winter. We're doing the plowing, I should say. So we're in the business of snow plowing. And so in the month of January, we provide plowing services to some customers. What we're going to do is we're going to want to record those revenues on the January income statement, even if we didn't get paid until a later date. So in January, on the income statement, we record sales revenue going up. And I'm just going to make a number up here, $10,000. Okay, so that's on the income statement. But we didn't get paid yet. Now, we don't have cash to increase. Remember that with bookkeeping, we're always affecting at least two accounts. So instead of increasing cash by $10,000, we're going to increase something called accounts receivable. Accounts receivable is a current asset, and it measures the amount of money that our customers owe to us. And that's what we're seeing happening here. We were able to, because of accrual accounting, we were able to record something on the income statement before it was received in the form of cash. Now let's say that in the month of February, the customer actually pays the bill. Then what's going to happen is this. Our cash account will increase by $10,000, and that's on the balance sheet. Now, we're not going to do anything on the income statement. What's going to happen is this. That receivable that we created up here is going to get erased. It's going to go away. So what we're seeing is this. The sales revenue is on the income statement in the period where we earned the income, not over here when we collected the cash. Okay? Everything here in February is just on the balance sheet, getting rid of an asset called accounts receivable, turning it into cash. It's one of my favorite things to do in business because we're improving our liquidity, and as you know, we need cash to run our business. If we were using the cash basis, nothing would happen here, okay? Because we didn't get any coins in our paw. We didn't receive any cash. So under the cash basis, this revenue would be reported in February. That's the fundamental difference between cash and accrual basis. And really, this is probably the best illustration. Accrual basis, put it on the income statement when you earn it. Cash basis, put it on the income statement when you receive the cash. There are some more details and complexities that we'll explore in class, but I just want you to have this kind of fundamental understanding of the difference between cash and accrual so that you have that foundation. Please understand, too, that most of the time we're going to be working in the world of accrual accounting and assuming that we're using accrual accounting because that is what's required by generally accepted accounting principles. As we wrap up our discussion of financial accounting, I want to leave you with a few broad concepts that will help set a foundation for the study of financial accounting when we get together in the classroom. There are some basic assumptions. Now, one of the assumptions is economic entity. In other words, we know what entity we're reporting. Okay? And that might seem like really obvious and basic, but understand that sometimes there could be multiple companies that are combined into a set of consolidated financial statements, for example. We also need to understand that the business itself is a separate economic entity from the owners and from other entities. So basically, we need to identify what is the economic entity for which we are gathering financial information, aggregating it, and then reporting it to people who are making decisions. Going concern. With going concern, we assume that the business will continue indefinitely. Now, of course, you guys have seen businesses that fail. You can probably look around your own neighborhood or businesses that you've encountered over the years, and some of those just don't exist anymore. But for financial accounting, we're going to be optimists and assume that the business will continue indefinitely. That allows us to measure things like accounts receivable. Accounts receivable would be pointless if the business didn't continue to exist. We need to assume that the business will be here next year and the year after, et cetera, et cetera. If we don't have a going concern, then we actually have to switch our reporting to something called the liquidation basis of accounting. That's a whole different topic. So we'll keep going concern. We'll be optimistic. Historical cost. What this means is that for the most part, we will measure financial statement amounts at what we paid for a transaction. There are a few times where we will deviate maybe and measure something at fair market value, but for the most part, historical cost is objective, it's verifiable, it's not debatable. We know if we spent $40,000 to purchase an oven for our restaurant, that's what it cost. Now, what is it worth today? I don't know. We'd probably have to get an appraisal done or something like that. That's why measuring things at the fair market value, there's more subjectivity involved. And for the most part, United States generally accepted accounting principles require us to measure things at what we paid for them, historical cost. That is different. There are some different guidelines when we get to international financial reporting, and there are some exceptions with the United States GAAP, but for the most part, historical cost is the rule. Time period. Very simply, we need to know the time period for which we're reporting. Is this an income statement for the month, for the year, for the quarter? Is it something just measuring a particular week or day? We have to be able to take the activities of a company and artificially break them up into chunks for reporting purposes. And then finally, monetary unit. We need to pick one. Is it the US dollar? Is it the euro? We just need to choose a monetary unit and consistently apply that monetary unit. A few other concepts. Financial statements should be consistent. So in other words, within a company from one year to the next, from one period to the next, we should be operating by the same rule book, the same accounting principles, so that we can compare one year to the next within the same company, right? Consistent application of accounting principles. Comparability might sound a lot like consistency, but what we're talking about with comparability is comparing different businesses and trying to make sure that they're operating by the same rule book. For example, let's say you were going to compare Lowe's, Home Depot, and Menards. 3 home improvement stores, same industry, really selling similar types of things. Well, if we want to compare the financial performance and the income statement, the balance sheet, and other elements of financial performance, we really want to make sure that Menards and Home Depot and Lowe's are playing by the same accounting rule book, US GAAP. Now, so we try to encourage that comparability. There are plenty of opportunities for discretion, even within United States GAAP. For example, maybe one of the entities uses last in, first out for inventory. The other one uses first in, first out. Could be that one of the entities depreciates equipment over 7 years. The other one does it over 5 years. Okay, so we do need to understand the differences in order to be able to make comparisons between companies as we evaluate their relative performance. Financial information is supposed to be relevant. In other words, it's supposed to provide meaningful information for whatever decisions that users are making. Okay? Whether that be a lender or an investor, whatever decisions they're making. And a lot of times it involves future cash flows. Think about it. If you lend money to a company, you're primarily concerned with this question: can they repay the loan with interest? So let's make sure the financial statements give relevant information to help answer that question. And I guess it goes without saying that financial statements should be reliable. They should be accurate. Conservatism. This has nothing to do with how you vote in political elections. Okay? What it means is if all other options are equal, we're going to present the least optimistic view. Now, don't misunderstand me. we're not going to make the financial statements look purposely bad. That's not the concept of conservatism. But if we have two equal options and one presents a little bit more optimistic picture and one is a little bit more pessimistic, we're probably going to go with that more pessimistic, because conservatism basically means we don't want to overpromise and underdeliver. We would rather underpromise and overdeliver. We don't want to paint too good of a picture. And then finally we have materiality. Now, materiality basically means, is it big enough to matter? Something that is material will affect the economic decision of an informed decision maker. Materiality could be a dollar threshold, but it also can be in terms of qualitative considerations. So take this for example. It's possible that, let's say you run a small restaurant, maybe a $10,000 or $20,000 error in the financial statements would affect your impression of that business's operations. Okay, but $10,000 or $20,000 would be nothing to a large chain like Pizza Hut or McDonald's or Burger King. Okay, a $10,000 error in financial statements of McDonald's would be unnoticeable. It wouldn't impact anybody's impression of the company's performance. So materiality can be expressed in terms of quantity, so in other words, magnitude of dollars, but it also could be qualitative. What if you had a dollar amount that was quantitatively immaterial? In other words, it's so small, it really doesn't matter, but it was just enough to turn a net loss to a net profit, or maybe it was just enough to allow a company to meet a financial ratio that is required by their bank to keep their funding in place. That's an example where something that is quantitatively small could end up being material because it impacts the decisions of people who are making choices about this entity. Finally, frameworks. We talked a little about United States GAAP. There are financial reporting frameworks that we will use. Probably most commonly US GAAP is what we'll talk about. International standards can come into play, but there are other frameworks as well. They're less commonly used, but they are options, especially for small businesses or for particular circumstances. Ultimately, what we want to do with external financial reporting is to be able to use this information to make decisions. One of the major things that we're going to explore throughout the semester is how do we use the information from financial statements to make decisions. We'll go into it in detail in the classroom, but I want you to understand that there are three broad categories: profitability, liquidity, and solvency. So we want to be able to use financial information to analyze, is the company generating a profit? If it is generating a profit, is it the right amount of profit? Just because you're making a profit doesn't mean that it's good enough. Are there opportunities for improvement? Could you enhance your profitability? We will learn how to use financial information to answer these questions. Liquidity. Will the company remain in business within the next year? Liquidity, a liquid asset is one that flows easily, like a liquid. Cash is the most liquid asset. If you need to pay a bill, everybody accepts cash, okay? So when we think about liquidity, what we're really doing is we're assessing the short-term health of the entity. We're going to learn techniques that we can use to analyze the short-term health of the company. Will it be in business within the next year? What's the likelihood? Then solvency. Solvency is the long-term health of the business. Will it be in business 5 years, 10 years, 15 years from now? We'll learn techniques for analyzing that as well. This is where we're going to head in the semester, is not so much the bookkeeping. We'll do a little bit of that, maybe some transaction analysis. But what we're really going to focus on is how do we use this information to make decisions about the health of an organization. There are a few fundamental concepts I want to make sure that you understand about managerial accounting before we explore them in more detail in the classroom. And the first thing, and this is very important, cost behavior. Costs can either be fixed, variable, or mixed. So let's talk about that for a second. A fixed cost. A fixed cost does not change when activity changes. So think about this. An example of a fixed cost might be rent. Okay. If you're running a restaurant, let's say your rent is $2,000 per month. You're going to incur a cost of $2,000 per month, whether you sell $50,000 worth of food to customers or $100,000 worth of food to customers. And that's the nature of a fixed cost. So it does not change with activity. A variable cost does change with activity. So with a variable cost, maybe we would say, the best example is miles per gallon, or fuel usage in your car. Let's say that every time you drive your car, you spend 30 cents on gas. That might be a little high, but you get the concept there. That's a fully variable cost. Drive more miles, spend more on gas. So the rate per unit is constant, but in total, the cost increases and decreases with activity. Then you have mixed costs. Mixed costs have both a fixed and a variable element. The best example I can think of there is electricity. So let's say that it costs $30 a month just to have electricity service at your house. Whether you use it or not, it's $30 a month. That's the fixed component. And then on top of that, it's, let's say, 2 cents per kilowatt hour. So there's both a fixed component and a variable component to this particular expense. If you don't use much electricity, your bill is going to be close to $30 for the month. If you use a lot of electricity, maybe it'll be $100 or $200 or something much greater. So these cost behavior concepts are very fundamental as we will explore something called cost volume profit analysis. We're going to look at decisions that need to be made and be able to, for example, let's say you wanted to figure out how many pizzas at a pizza restaurant do I need to sell just to break even. In other words, to have my revenues equal my expenses. That's an important thing to know if you're running a pizza restaurant, because if you sell fewer than that number, you're going to be in the loss area. And I don't know about you, but I'm not in business to lose money. So I'd like to know, what is my break-even point? And then let's set strategies and plans to exceed that break-even point to make sure that we can earn a profit. That's just one example of the way that we will be using cost behavior to make decisions in managerial accounting. As you might recall, one of the primary foci of managerial accounting is to make decisions. And we need to understand that some costs are relevant for decisions and some costs are not relevant. Differential costs are relevant. So in other words, if you have two options and there's a difference in the cost between those two options, that becomes a relevant decision. Let's say that I'm recording this in Grand Rapids, Michigan. Let's say I want to go to Chicago for a concert. I could drive my car, I could take the train. Okay? The cost of a train ticket would be relevant to that decision because it's a differential cost. If I drive the car, I don't have to buy a train ticket. If I take the train, I do have to buy a train ticket. So a general rule is that differential costs are always relevant to making decisions because they differ between alternatives. Sometimes we would call this an avoidable cost. In other words, if I take the train, I could avoid filling the gas tank of the car. If I drive the car, I could avoid paying for the train ticket. Always relevant. Sunk costs are never relevant, even if we want to try to make them relevant, emotionally relevant. They're in the past. They're sunk. There's nothing you can do about them. Take that example of driving versus taking the train. Let's say that I put a license plate on my car, and earlier in the year I paid for that license plate. That is irrelevant to the decision whether I should take the train or drive. And here's the reason, is because I'm going to put the license plate on the car either way. It does not differ between alternatives. It's not avoidable, and it's in the past. Okay? There's no way it can change in the future. So sunk costs are never relevant to a decision. Opportunity costs are relevant to decisions, but they're easy to overlook because opportunity costs are not usually sitting on a financial statement staring us in the face. It's the cost of the next best alternative. Take this for example. If I take the train to Chicago, what could I do with my time? Well, I could work on a lecture for class, I could grade some exams, read a book, take a nap. These are all things that I could do on the train, but I couldn't do if I'm driving my car. So let's say that the next best alternative on that train would be I would grade some exams. Well, an opportunity cost of driving my car would be I can't grade exams during the travel time because obviously it wouldn't be very safe to grade exams while I'm driving a car. That is relevant to my decision whether I should drive or take a train, but it's not always obvious. So opportunity costs are relevant, but you really have to think about them and seek them out in order to identify what those are. Finally, this. Managerial accounting often is trying to figure out what does something cost, a cost object. A cost object could be a product, it could be a service, it could be a class. Here at Grand Valley, we could try to determine what did it cost for me to produce this video? What is the cost of producing the video? A cost object is anything that you're trying to determine its cost. And we have three basic building blocks for cost: direct materials, direct labor, manufacturing overhead. Now what we're going to say about direct materials and direct labor is that those are easy or convenient to trace to a cost object. So in other words, let's think of an example here. Let's say that it's a car. We're manufacturing an automobile. It's pretty easy to figure out that this car needs 4 tires, and each tire costs, let's say, $100. So the direct materials cost for tires for one car is $400. And it would not be too difficult to figure out how much 1 hour of labor costs, and if we know how many hours or minutes of labor is required to produce a car, we can trace that direct labor to the cost of the car. So direct materials, direct labor can be directly traced to a cost object. The difficulty comes here with manufacturing overhead. Manufacturing overhead is a broad category of items that really are not easy or convenient to trace to a cost object. In some cases, it might be nearly impossible. Take, for example, the automotive factory. So let's say it's a General Motors automotive factory, and they have electricity bill, and the electricity bill might cover some of the office area, some of the production area for this car, some of the production area for this car, maybe shipping and receiving, maybe for maintenance area, janitorial, various portions of the factory. It may not be easy to see how much of that electricity bill should be traced to a particular automobile or line of automobiles that's being produced. So instead, what we do is we take costs like that and we put them into a bucket called manufacturing overhead, and then we allocate them to cost objects. And that's where we spend a lot of time in managerial accounting, is trying to determine what is the best mechanism for allocating or sprinkling this overhead among cost objects. So keep this in mind. Those are the three basic building blocks: direct materials, direct labor, which are traced; manufacturing overhead, which is a little bit more cumbersome. It gets allocated, but these are terms that we're going to be exploring in more detail when we get together in the classroom. Where does this lead us? I've given you an overview of financial accounting, a little bit of managerial accounting. We're going to explore these in much greater detail throughout the semester, and really from a user's perspective, not from a preparer's perspective. Sure, I'll teach you a little bit how to prepare an income statement or a balance sheet. We'll go through some transactions and decide how to analyze and report those transactions. But the major focus in the graduate study of accounting should be on how to use the information to make decisions. To that end, I want you to start to think about right now what your project might be. Each group is going to select one project, and you're going to tackle that project throughout the semester using techniques from the class. So start to think about a practical application right now. I'd like you to think about a problem that you're encountering at work, or I suppose it could be in your personal life too, something that you can share with the class and with your group and the class as a whole. But I want you to come up with something that needs to be solved. It could be replacing a piece of equipment. It could be, should our company convert to solar energy? Should we hire somebody? Should we buy a new business? Should we add a piece of machinery? These are all options I've seen, and these are projects I've seen people tackle in the past. So find something at your place of employment or in your life where you think accounting information will be helpful in arriving at a decision. It might be financial accounting information, it might be managerial accounting information, and then I'm going to ask each one of your groups to select one project. As a group, you pick a project, and we're going to work on it throughout the semester. And you're going to come up with an answer with a recommended course of action. And then during your final exam period, you're going to present it to the class.